Hi guys, right, so this is part two. Um, so part two, what I want to do here is, in a way, you have to kind of please read, get through part two and maybe three before you really come to deferred tax. But they're going to be short. But I just need to kind of show you what's happening conceptually. But in the end, the truth is, it's actually quite straight. When you come to doing a question, you're just subtracting two things, and I'll show you what they are. But the point is, so you conceptually, if you want to take the time to just understand what's happening here, you just need to kind of work. So I'm going to use this question. I'm going to expand this question to discuss what's really happening conceptually. Right, so I'm just going to take this question. I mean, I'm not actually answering this question just yet, but I'm just going to take the same question. So a company's financial statements show profit before tax of £1,000 in each year of year one, two, and three. This profit is stated after charging depreciation of £200 on the purchase of an asset costing $600, if you like, over a 3-year period. So I'm just going to use this business here. So here I am here, right? And I have here this business costing, well, their profits year one is £1,000, year two is £1,000, year three is £1,000. So I'm not even going to talk about that depreciation yet. I just want to, this is the first part of my video, and I want to talk about what we typically refer to as permanent differences, right? But let's just see. I just want to talk about that first. So you just have it etched in your head and it's there. You'll never have a problem with it. Now, here's the thing. The accruals concept is central to everything in accounting. It's so central. I mean, it's the heart of accounting. Even up to the discussion of taxation. The taxation in a period, the taxation is to do with is charging a tax to the income made in that period. So for example, the point is that if you make income, right, I'm just writing this here randomly, if you make income of £1,000 in a year, well, your tax should be 30% of that. I mean, the relevant tax, the accrued tax for that period is 300. If you make income of £2,000, your tax should be 30% of that is 600. That's what the tax should be as far as the accounting is concerned. For us to talk about fair profits, right? For profits to be true and fair, it's not really what the tax office says. The tax office could actually give you a completely different figure. But in us looking at what the profit for the year is, we need to put in the tax that matches the income for that period. That's the first thing, and that's what we want to see. Right. And that's the key point here. This question of the tax, it's a matching issue. The tax for the year should match the income for the year. More income, more tax. Less income, less tax. That should be what determines, if you like, the point. And the point really is to do with the fact that when you buy an asset, the intention is that you intend to sell this asset, so to speak, and you will get at least, well, when I say sell this asset, use this asset to generate income, and you will at least get the cost of that asset over the coming years. So you are expecting at least income which is equal to the cost of that asset, even though it's coming over a number of years, right? So taxation will really be similar, if you like, over that period of time. Right. So let's just deal with this question here. Oops. Oh, I didn't mean to I didn't mean to do that. Um, let me come back here again to this 1000 year 1, year 2, and year 3. Now, if this was my I'm just going to say this was my I'm just going to make this up now. 1500. Imagine I had profits of 1500. Let's just say this was profits before entertainment. So this is my profit before entertainment, and now I have entertainment, and I deduct entertainment of 500. So now here's the thing. Here's my income. My income for the year was 1,500. I deduct entertainment, so my profits are actually 1,000. I mean, entertainment technically is an allowable expense as far as the standards are concerned, which is why I can deduct it, right? So entertainment is actually 1,000. So I mean, 500. So I deduct entertainment, if you like, and I have 1,000 of profits showing. So really and truly, I should be recognizing tax on 30% of 1,000. I should be, right? This is the truth. This is the income generated in that period. So taxes should be 300, 300, and 300 forever if I'm doing this, right? Now, for tax purposes, HMRC does not allow you to um, to what's the word? The HMRC does not allow you to recognize entertainment. So, unfortunately for you, when you come to do your tax computation, you have to sort of say, well, you see that 1,000? I need to add the 500 back and that gives me 1,500. That 1,000, you have to add the 500 back. That gives you 1,500. You see that 1,000? You have to add the 500 back. That gives you 1,500. And then what you then do is you do 30% of 1,500. 30% of, if you like, of 1,500 is 450. So what ends up happening here seems a bit unfair. You are paying taxes of 450. This is an expense, yes, on income that really was 1,500. Sorry, on income really that was 100. I mean, you suffered this expense, so really and truly, this should have been something. This should have helped you reduce your taxes for the year, entertainment. But it's a bit unfair because you see this 450, it doesn't quite correlate to this 1,000. This 450 is for this, really and truly. So unfortunately for you, when the taxes really should be 300, unfortunately for you, you are forced to pay 450. There is nothing you can do about it. There's just nothing. It's just what it is. It's just the fact that HMRC, we're not pushing back, because when I come to talk about deferred taxes just mean later taxes. This is not a matter of maybe later on in the future something will change. No, 100% HMRC does not allow certain expenses to go through. So we refer to this type of difference as a permanent difference, where the taxation you're paying in the year does not relate to the actual income in the year. It doesn't, because unfortunately entertainment is not an allowable expense for taxation purposes. So really you're paying taxes, much higher expenses in a year where your profits are actually truly less. So imagine now that you now have this you're paying this tax of 450 where you should really be paying taxes of 300. So we refer to these type of differences as permanent differences. There's nothing you can do about it. There's no question about us being delaying this expense. It's just what it is. And that's it. So this video just wanted to talk about permanent differences. This is not deferred tax. It's just the fact that we have these differences in the tax bill due to the fact that certain expenses will never ever be allowed as allowable expenses for taxation purposes, and hence you will end up paying higher taxes, and this is referred to as a permanent difference. Cool, great stuff. So I'll see you in the next video where we start the next bit to talk about, well, deferred tax, but I will take you through the process, which you just watch and follow and sort of see what's going on. But the key point I want to highlight again, the key element I want you to draw from all of this for the meantime, is that the taxation expense is just like any expense. Electricity, it must be accrued for the year, just for that year. Electricity for the year must match the income earned for that year. We want it to match, right? So if you see yourself recognizing a tax expense that doesn't match the income for that year for whatever reason, we need to adjust it so it matches, if you like. And that's what we're really going to be talking about as we go along. And this is possible because HMRC or the government might have certain allowances that allow you to gain some benefit that ends up happening such that the tax expense doesn't quite match from an accounting accrual point of view the income for that year. Okay, great stuff. I'll see you in the next video.